The global investment environment is full of uncertainty. Investors are seeking clarity and ways to unlock more consistent investment outcomes during a period of unpredictable conditions. Innovations in data analytics and technology are helping investors better understand markets. But is AI the answer to consistent investment performance? And how can human judgment have the potential to create more resilient investment results?
There are these things that come up where humans have to be much more involved, and humans can really add a lot. We need humans, we need machines, but this idea of cutting through the noise and figuring out how to optimally blend all these ideas together, in general, machines are really good at that.
Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Pulido. Coming up on The Bid, I'm joined by Ronald Kahn, Global Head of Systematic Investment Research at BlackRock. Ron has played a foundational role in shaping the field of quantitative investing over the past few decades. He'll talk about what it means to pursue consistent alpha in today's markets, how data and technology have evolved investors' expectations, and how systematic investing continues to deliver potential in uncertain conditions. Ron, thank you so much for joining us on The Bid.
It's great to be here, Oscar.
Ron, you and I haven't spoken yet on The Bid, but we have had some of your colleagues from the systematic investing business who have joined us in the past. I'm thinking of people like Brad Betts and Jeff Shen, who have come and talked to us about how they use data to understand market complexity. Of course, this is a topic that you have been tackling for a few decades. In fact, you quite literally helped write the book on systematic investing many years ago. And so it's great to talk to you about how you're, looking at the current environment, all the uncertainty and the volatility that we see. How do you think about the pursuit of consistent alpha? And why is that goal so important for so many investors?
Well, Oscar, you've actually focused on the central issue for investors generally. So how do we deliver consistent positive alpha in a world that's full of volatility and where ideas work for a while and then they stop working? And the only way to do that, the only way we know how to do that, is through constant innovation. We've got to constantly be coming up with new ideas to replace the old ideas that stop working. As you know, active management is a very competitive industry, and we find ideas that give us some edge that the market hasn't quite figured out yet. But the market always figures it out. And so we've got to keep looking for new ideas and replace the old ideas with new ones. And so that's how we try to deliver consistent alpha. And I would add, we've been doing this for 40 years now, and we've learned a lot over that time. And the way we add value these days is all through informational advantages, which I was alluding to a second ago, that we try to figure out things that help drive returns, but that the market hasn't figured out yet. And so that's why we use all of this data, AI, machine learning, and everything. It's all to try to maintain these small edges and deliver the consistent performance.
And you mentioned, Ron, all of this data. In fact, it is a lot of data. It has evolved a lot over the years as well. In fact, one of the terms I think that you and your team often use is alternative data. So talk to us a little bit about how has the use of that data changed over time, and maybe you can give us some real world examples of how that feeds into the investment decision-making process.
Yeah, so I'll give you a couple of examples. And the first one is about understanding individual stocks. And what alternative data allows us to do is to move upstream of companies having earnings conference calls or issuing earnings. So at that point, you know exactly what the company has earned over the last quarter. What I mean by upstream is we can keep track of exactly how many people are walking into every restaurant and every retail store every single day. Now, we don't know what stores you're walking into or what restaurants you're going into. It's aggregated data. We're not interested in what individuals are doing. But what we found is it's not as good as knowing the actual earnings, but if we see more people walking into a particular store week after week, that does do a pretty good job of predicting that earnings are going up. And so it's alternative in that it's not how people used to think about things. It's also very much driven by advances in technology. How are we able to do this? Well, if you happen to be carrying a cell phone, which is going to be true of pretty much everyone in the world these days, your cell phone is always looking for Wi-Fi connections. That's how, when you walk into a store, it registers there's another phone. I'll tell you a funny story about these types of data. We were doing a pitch for a client, and we did something that's a little dangerous. We had a live demo, and we were talking about a large fast food company. Someone in the meeting said, oh, there's one of those like 2 blocks from our office. Like, what do you see there? So we zoom in on that, and we go like, oh, that's interesting that the foot traffic has gone down a lot in the past 3 months. And he says, oh, that makes total sense. There's a big construction project in front of that building, and it's not even obvious that the restaurant is still open. So there's an interesting granularity that we can see, but it's really when we aggregate it up, we can say, all right, at the company level, what's going on with earnings? So as another example, focused on sort of macroeconomic trends, we're interested in economic growth in countries all over the world. What we've discovered is we can use satellite imagery to measure the amount of truck activity in every particular country. That allows us to have an independent measure, so we're not dependent on the governments for those numbers. This gives us a macroeconomic view and an independent view that's useful in determining what are the more attractive countries to invest in.
So it's interesting when you're talking about data, it sounds like it can be used both from a macro perspective, understand the economic growth in a particular country, but you also mentioned looking at foot traffic going into a restaurant. And I think you said kind of moving upstream, which I interpreted as trying to get a little bit of insight into what earnings might be for a company going forward and using data to help inform that. Ron, when we've talked to some of your colleagues in the past and we talk about all of this data, we also talk about the technology, the computing power that is needed, the infrastructure that is needed. Maybe talk a little bit about what you have seen over your many decades in the industry when it comes to the technology.
Yeah, so this is particularly systematic investing is a technologically intensive business. And I'll tell you one thing that people don't appreciate in this world of alternative data. So in the old days when we still look at earnings conference calls and financial statements. If you look at a financial statement, this is obvious. You know the company they're talking about. It's listed right in the front. There's usually a ticker you can see, and so you can connect the earnings to a lot of other data. In the world of alternative data, often we might be looking at things like product reviews for different products. And so, we might collect product reviews about the latest iPhone. The iPhone's a simple example. We know what the company is. But there are millions of products. And so the ability to just map, here's a set of data, what company does it refer to? That's required a years-long effort to build out all of the connections between companies, the names of their products, the types of things that people might say about them. That's just one example. Another example is, more generally, how do we keep track of all these data? They're really voluminous, and they're not the type of data that would fit well into a spreadsheet. Like you could put anything into a spreadsheet, but the data we use, the spreadsheet would be enormous. So we've had to develop different structures so that we can efficiently keep track of data.
Ron, there's some other terminology in this space as well. Often we hear the word signals used when it comes to systematic investing. So maybe we can also, kind of keep talking about some examples of what are these signals? What are examples of ones that have worked in more challenging or unprecedented periods of time? And what have they revealed about the economy or perhaps about companies?
Yes, that gets at something that's very, very interesting to us, and we've put a lot of effort into over recent years, which is how do we predict stocks or understand movements of stocks in unprecedented periods? So I'll give you two examples. So one, if you go back to the COVID period, here we're living through a global pandemic, and it's fair to say that almost no investor has ever lived through this before. So on the one hand, it seems hugely impactful. And on the other hand, we have no data. We don't have people on the team who lived through the Spanish flu epidemic in 1917. And so what do? Well, we've got so much alternative data. We did a hypothesis that as vaccines were developed, they were rolled out in different countries at different times. And our view was that as the vaccine is rolled out, mobility will increase. People will start walking around. They'll buy more things or different things. They'll go into stores. They'll go into restaurants. And so we both have this hypothesis that this is connected to vaccine rollouts. And at the same time, we have data that tells us how mobility is changing. And so we put that all together, the economy's restarting as vaccines rolled out. Let me give you a more recent example. There's been a lot of talk and action in the US around tariffs. And we looked at how individual companies were going to be exposed to tariffs. Were they bringing materials in from other countries? Were they exporting? And it's the systematic infrastructure that allows us to answer questions like, how would a hypothetical tariff impact every single company? And we use this to put together trade baskets, stocks that will benefit, stocks that will be hurt, and we can overlay that on other things we do to protect ourselves when the tariffs were announced. And even now, there's a lot of volatility around tariffs. We continue to monitor all this.
It certainly seems like as the world gets more complex, having more data is powerful. But I don't know about you, Ron, but in my own personal life, when I have to make a decision, sometimes when I'm presented with more information, it can be a bit overwhelming. So if I take that now to the investment decision-making process, how do you manage that? How do you make sure that with all the data at your disposal that you cut through the noise and you focus on what really matters in order to generate that consistent alpha that we talked about at the very beginning?
Yes. Well, Oscar, what you're raising is a very human concern. And I sometimes say, like, if you look around a BlackRock office and you say, how many people in the office can juggle 3 balls? And you'd probably find a number of people who could. If you ask how many people can juggle 8 balls, no one. Those people are in Cirque du Soleil. And so you very quickly go from something that humans can do to humans can't do. And in the world of signals and data, when we started out, we had 5 different signals, 5 ideas. And the humans decided how much weight to put on each of those. Nowadays, if we have 1,000 signals, humans can't do this. And so we use AI and machine learning to come up with the optimal blend of all these ideas. And that blend, relying on machines are much better at this than humans. And what we have seen is that what I usually say is 8 years out of 10, the machines will do much better than the humans. But there are these things that come up where humans have to be much more involved, and humans can really add a lot. And so we want both of those things. It's sort of like, airplanes. Most of the time, what people tell me is that the autopilot is actually better than the human pilots. But every once in a while, the plane runs into a flock of geese, and you want Sully Sullenberger in the cockpit to figure out what to do, because that wasn't in the data. We need humans, we need machines, but this idea of cutting through the noise and figuring out how to optimally blend all these ideas together, in general, machines are really good at that.
And Ron, you're talking about humans and the role that they play in the systematic investing process. I think it's fair to say that sometimes one of the perhaps misconceptions about this field is that it's all about algorithms, and you've mentioned AI and you've mentioned machine learning, and it can feel like it is really just a lot of technology working in the background. But humans do play an important role, and you started talking a little bit about this, but tell us a little bit more about where does the creativity and the human insight factor into the systematic process?
Yeah, so humans are involved in every single step, obviously. So even if you think about, the technological systems that we've built, it's all humans who built those or conceived of them and understood how to design them, how they would work. And I would say, I've mentioned we have on the order of 1,000 signals. We've developed these over 40 years where humans have worked on, for 2 to 3 months to develop each one of those signals. It's really a multi-decade effort with a lot of human input. And I would say, I gave you the examples of things we did during the pandemic, things we've done around tariff policy. There's a lot of evidence that at least the current state of the art with technology, humans plus machines will outperform humans by themselves or machines by themselves. That's the world we're living in today, and so we need both.
It sounds like 1 + 1 would equal 3 in that case, where you have humans and machines making each other better. Speaking of humans, for most of the investors who listen to the bid, as they're hearing you talk, they might be thinking, well, I don't have access to all this data, all this technology, all this machine learning. So what lessons should they take from the approach that you and your team have been implementing for many years?
At the heart of our approach is really a lot of discipline and process. All successful investing turns out to be around discipline and process. And so I think that's something that everyone should think about. And when I think about process, in the world of BlackRock systematic, process is very quantitative. But you can have a process that is just, a set of things you always do, and you want to be disciplined about following that. It doesn't have to be quantitative. I would say a couple of other things. One is our disciplined process, it allocates, we take risks in proportion to the potential opportunity. And so maybe that's sort of, these things are going to be a little bit more abstract, but I think, thinking about where are the opportunities and focusing on those. We can do this over thousands of opportunities. Individual investors can still choose managers. And, you can look at where do you think there are more opportunities? Is it in equities? Is it in fixed income? Is it in private credit? Is it in the U.S. or international? So there are things that individual investors can think about. And the last thing is the insight that successful investing requires two things. We've got to have skill every time we make an investment decision, and then we've got to diversify across lots and lots of investment decisions. And so when you look at the systematic approach to investing, it's got to have both of those things. We've got to have good investment decisions, and then we've got to diversify across those decisions. And that can apply to individual investors just as well.
Ron, when I spoke to Brad Betts last year, I recounted to him a quote that I have seen up on the wall with your name attributed to it, because if I'm not mistaken, it's the first sentence in the book that you wrote, which is the art of investing
is becoming the science of investing.
Well, Ron, and you have taken us down a history lesson of the science behind systematic investing and put it in some real world examples of how it can benefit our investors. We appreciate you doing that with us here and for joining us on The Bid.
Great. Thank you, Oscar. It's great to be here.
Thanks for listening to this episode of The Bid. Next week, we turn our focus to retirement savings and what new legislation means for your retirement account. Subscribe to The Bid and don't miss the episode.